Welcome to This Explainer. Today, we're diving deep into Tokyo Lifestyle's fiscal year 2026 financial results to uncover the truth behind what looks like, well, a massive business paradox. If you've ever looked at a company's financial headlines and thought, wait a minute, how does that math even work? Then you are in exactly the right place. So let's jump right in, because we're about to untangle a really fascinating story about revenue, shifting strategies, and honestly, a wildly complex tax situation. On the surface, if you just glance at the top line, the company had an absolute blockbuster year. They surged their total revenue by an incredible 77.6% year over year, hitting an impressive $373.2 million. Now, in the retail and wholesale world, achieving almost 80% growth in a single year, that's a massive win. It signals huge consumer demand and really aggressive expansion. You'd naturally expect they're popping champagne in the boardroom right now. But here is where the story takes a wild turn. Surprisingly, while their revenue literally skyrocketed by hundreds of millions of dollars, their bottom line did the exact opposite. Their net income plummeted from $6.6 million in fiscal year 2025 way down to just $700,000 in fiscal year 2026. Think about that. A massive leap forward in sales paired with a giant step backward in net income. And that leads us directly to our central mystery. How on earth does a company sell $163 million more, but somehow manage to earn nearly $6 million less in pure profit? The biggest takeaway here is that headline numbers rarely tell the full story. To actually understand a business's health, we really have to look under the hood. So let's figure out if Tokyo Lifestyle's business is fundamentally broken, or if there's something much more strategic happening behind the scenes. Section 1. The Asset-Light Strategy Pivot. To solve this paradox, we've got to look past those top-level numbers and examine a very deliberate strategic transformation. While their directly operated physical retail stores, the traditional brick and mortar, brought in a respectable $19.8 million, their franchise and wholesale segment absolutely exploded to $346.7 million. So the vast majority of their explosive growth came not from opening hundreds of their own expensive retail shops, but from selling directly to other businesses. Digging just a little deeper into that wholesale boom, this 86.9% growth in the franchise and wholesale channel didn't just happen by magic. It was driven primarily by a massive 320% surge in their luxury goods business. And on top of that, they aggressively expanded their network by adding 68 brand new wholesale customers. They essentially found a super high-demand niche in luxury and just rapidly scaled their distribution. The really crucial point to grasp here is that Tokyo Lifestyle is evolving far beyond being just a traditional retailer. Instead of relying heavily on capital-intensive physical stores, where you're paying massive rents, hiring hundreds of cashiers, and constantly managing localized inventory, they're transforming into a diversified consumer lifestyle platform. By utilizing wholesale and franchises, they can scale their brand footprint and move massive volumes of luxury goods much, much faster, and with significantly lower overhead costs. Section 2. Decoding the profit margins. We know the revenue mix shifted heavily toward wholesale. And listen, this required a very specific trade-off. Selling wholesale inherently carries lower gross margins, simply because you're selling at a discount to other retailers. And we see that. Their overall gross margin dropped from 11.4% down to 7.5%. But look at the other side of the equation. Running a wholesale business requires far less overhead. Because of that shift, their operating expenses dropped from 9.1% of revenue down to just 6.7%. So they're making a bit less profit per individual item, but they are spending significantly less to actually run the business itself. This is a brilliant illustration of a concept called operating leverage in action. Operating leverage happens when a company's revenue scales way faster than its operating costs. For a growing business, this is literally the holy grail. It shows us that even though the top-line gross margin percentage shrank, the core business engine is actually scaling much more efficiently. Every new dollar of revenue they bring in costs them less to generate than the dollar right before it. And hey, we don't just have to guess that this was their master plan. Principal Executive Officer Mei Kaniyama explicitly stated that these margin shifts were a deliberate optimization for sustainable growth. She made it crystal clear that this is about enhancing long-term returns, absolutely not a sign of weaker operating performance. They willingly traded those high gross margins for high volume and supreme operational efficiency. Principal Accounting Officer Yuichiro Haga backs this up with some truly compelling math, too. Achieving 77.6% revenue growth while your operating expenses only rise by 29.6%. That is incredibly difficult to pull off. As he points out, this proves the underlying financial quality and the sheer scalability of this new strategy. Their core operating model is functioning exactly as designed, and on an operating basis, it's highly profitable. Section 3. The consumption tax anomaly. Okay, so if the core asset-light business is scaling so efficiently and the operating model is super healthy, what actually dragged that final net income number down so drastically? Well, the answer is a massive multi-year headache with the Tokyo Regional Taxation Bureau. This whole saga kicked off back in 2022 over incomplete export documents from some of the company's suppliers. That led to reassessment notices, a formal request for review filed by the company, and eventually a national tax tribunal ruling in early 2025 that actually annulled the original disposition. But here's the kicker. Because that tribunal annulment invalidated certain downward tax adjustments the company had previously relied on, Tokyo Lifestyle suddenly had to recognize $2.2 million in additional consumption tax and surcharges this year. This one-time $2.2 million hit completely skewed the final net income figure. So the absolute key takeaway here is that the massive drop in net income was primarily caused by these complex historical tax factors, not some failure of their underlying retail and wholesale operations. Section 4. Expanding the global footprint. With those margin trade-offs logically explained and the tax anomaly totally isolated, the fog really lifts. We can clearly see a thriving, profitable core business that's now aggressively expanding its global reach. I mean, their international expansion is gaining serious momentum right now. Overseas sales now make up nearly half, 47.1% of their total revenue. They aren't just a domestic Japanese player anymore. They successfully opened new stores in Hong Kong and Australia this year, all while actively broadening their global wholesale distribution network to get their luxury and beauty goods into even more markets worldwide. And they're not just expanding, they're actively optimizing the network they already have. For instance, rather than just sitting there bleeding money on an underperforming physical store in Japan, they took action. They converted it into a franchise location operated by local partners. This is brilliant omni-channel optimization. It immediately improves cash flow and working capital for Tokyo Lifestyle, pushing the physical retail risk onto the franchisee while keeping that wholesale product revenue flowing right into their pockets. And that perfectly brings us to the big picture. We've decoded the paradox. The plummeting net income was basically a tax mirage, hiding an incredibly successful pivot to a high-volume, low-overhead business model. Which leaves us with a final, really exciting thought to ponder. As macroeconomic conditions improve and global consumer demand continues to recover, just how vast could Tokyo Lifestyle's highly scalable, asset-light wholesale network become in the years ahead?